Something's happening in the silver market right now that most people aren't paying attention to. While everyone's distracted by the daily noise, a perfect storm is quietly building. And when it breaks, the move could be unlike anything we've seen in decades. Let me show you what I'm seeing, because the signs are everywhere, once you know where to look. Silver just did something it hasn't done in years. It broke through a major resistance level that's held it down for over a decade. We're talking about a technical breakout that traders have been waiting for since the last major bull run. The metal pushed through and held above levels that previously acted like a ceiling. That's not just noise. That's a structural shift in market dynamics. But here's what makes this different from every other breakout attempt we've seen. This time, the fundamentals are lining up in a way they haven't before. Industrial demand is hitting record levels. Solar panel production alone is consuming silver at rates that would have seemed impossible just a few years ago. Electric vehicles, 5G infrastructure, medical applications, the list goes on. Every major technological trend of our time requires silver. And unlike gold, you can't substitute it. The metal's unique properties make it irreplaceable in these applications. Now, while that's happening on the demand side, let's talk about what's going on with supply. Global silver mine production has been essentially flat for years. The easy deposits have been found. The high-grade ore bodies have been depleted. What's left requires more energy, more capital, and more time to extract. And here's the kicker. Most silver comes as a byproduct of mining other metals like copper, lead, and zinc. So silver supply is largely dependent on the economics of those other metals, not silver itself. Think about what that means. Demand is surging from multiple directions simultaneously. Supply is constrained and can't respond quickly even if prices rise. This is the setup for a supply deficit that could last for years, and the market is just starting to wake up to this reality. But there's another layer to this story that most people miss. The paper silver market versus the physical silver market. On the COMEX, massive amounts of silver trade every day as paper contracts. Futures, options, derivatives. It's a leveraged casino where the same ounce of silver can be claimed by multiple parties. The estimates vary, but some analysts suggest there could be over 100 paper claims for every physical ounce available for delivery. For years, this paper market has kept a lid on silver prices. When physical demand pushed prices up, paper selling would knock them back down. It's been the pressure release valve that prevented silver from truly running. But something's changing. The amount of silver available for delivery in COMEX warehouses has been dropping, not gradually, dramatically. We're seeing drawdowns that suggest someone, or multiple someones, are taking physical delivery and removing metal from the system. Quick aside here, if you're sitting on retirement savings and you're concerned about where all this is heading, I put together a free guide that shows the savings secrets thousands of American retirees are using to protect their hard-earned wealth. It's in the description below. Just something to check out if you want to understand your options better. Now back to what's happening in these warehouses. When registered silver, that's the metal available for delivery, starts disappearing at this pace, it tells you something important. The people with the resources and information to know what's coming are acting. They're converting paper claims into physical metal. They're moving it out of the system. And they're doing it quietly, before the crowd catches on. Let's talk about who these players are, because this isn't retail investors buying a few coins. Central banks in emerging markets have been diversifying away from dollar-denominated assets. They've been loud about their gold purchases. But silver, that's been happening more quietly. Industrial users who need silver for production are securing supply chains, locking in physical inventory before prices potentially spike. Investment funds are positioning for what they see as an inevitable supply crunch. And then there's China, always China. The country is both the world's largest silver producer and largest silver consumer. They're using massive amounts domestically for their industrial base, but they're also importing, heavily. The data shows China bringing in physical silver at rates that don't match their industrial consumption alone. Where's it going? Strategic reserves? Private accumulation? We don't know for certain, but the metal is flowing east and not coming back. Here's where the story gets really interesting. Remember how I mentioned the paper to physical ratio? That leverage works fine in a stable market. But what happens when physical demand overwhelms the system? What happens when too many paper contract holders decide they want actual metal instead of cash settlement? History gives us a preview. Back when the Hunt brothers tried to corner the silver market, the exchange changed the rules mid-game to prevent delivery. They went to liquidation-only trading. The Hunts were forced to sell, and the price collapsed. But here's the thing, that was a concentrated position by a few players that regulators could target. What we're seeing now is diffuse. It's industrial users, investment funds, central banks, and millions of individual investors all moving in the same direction for different reasons. You can't just change the rules and make that go away. The technical picture is screaming at us too. Silver's been in a massive consolidation pattern for over a decade. Traders call it a cup and handle formation. It's one of the most reliable bullish patterns in technical analysis. The cup forms as the price declines, bottoms, and recovers. The handle is a smaller consolidation near the highs. When price breaks out above the handle, the measured move projects to levels that seem almost unbelievable. Based on the depth of this pattern and the length of time it's been forming, the technical target sits well above previous all-time highs. We're talking about a move that would take silver into territory it's never seen before, even when adjusted for inflation. And the breakout is happening right now. The metal pushed through the resistance, pulled back to test it as support, and is now attempting to continue higher. This is textbook technical action. But technical analysis only tells you what the chart is doing. It doesn't tell you why. For that, we need to understand the macro environment. And this is where things get really compelling. The global monetary system is under stress in ways that aren't immediately obvious to most people. Central banks printed trillions in new currency over recent years. That money is still in the system, looking for a home. Real interest rates, that's the nominal rate minus inflation, have been negative for extended periods. When you can't earn a real return in bonds or savings accounts, where do you go? Hard assets, commodities, things that can't be printed. Gold has been the traditional safe haven, and it's been performing exactly as you'd expect in this environment. But silver? Silver has been lagging gold for years. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, got stretched to levels we haven't seen since the Great Depression. At the extremes, it took over 100 ounces of silver to buy 1 ounce of gold. Historically, that ratio tends to revert to a mean somewhere between 50 and 70. When it gets stretched to extremes, it snaps back, hard. And when it does, silver doesn't just catch up to gold, it overshoots. The metal's volatility works both ways. On the downside, it falls harder than gold, but on the upside, it runs faster and further. We're starting to see that ratio compress now. Silver is outperforming gold on a percentage basis, and if history is any guide, we're in the early innings of that move. As the ratio continues to normalize, the gains in silver could be multiples of what we see in gold. That's not speculation. That's just math based on historical patterns. Let me paint you a picture of what happened the last time we saw a setup like this. Go back to the late 2000s, silver was trading in single digits. The global financial crisis hit. Central banks responded with unprecedented monetary stimulus, and silver went from under $10 to nearly $50 in less than 3 years. That's a 5-fold increase. Life-changing returns for anyone who positioned early. But here's what's different this time. The monetary stimulus then was measured in billions. Now we're talking trillions. The structural supply deficit wasn't as severe then as it is now. Industrial demand wasn't being driven by the same technological megatrends, and the paper market wasn't as stretched. Every factor that drove that previous bull run is present now, but amplified. Think about the implications for a moment. If silver were to simply return to its previous all-time high, we're talking about significant percentage gains from current levels. But what if it goes beyond that? What if the combination of industrial demand, investment demand, and monetary factors pushes it into new territory? The upside potential is asymmetric. The downside is limited by industrial demand and production costs. The upside is limited only by how far the monetary situation deteriorates and how severe the supply deficit becomes. Now, I know what some of you are thinking. This sounds too good to be true. Markets don't just hand out free money. There has to be a catch. And you're right to be skeptical. Let me address the risks, because they're real. The biggest risk is a deflationary collapse. If the global economy seizes up, if credit contracts violently, if we see a repeat of 2008 but worse, then industrial demand for silver could fall off a cliff. In that scenario, the investment demand might not be enough to offset the loss of industrial consumption. Silver could get hit hard in the initial panic, just like it did in 2008 when it briefly dropped below $9. But here's the thing about that scenario. It would likely be temporary. Central banks would respond with even more aggressive stimulus. And when they do, when the money printing really accelerates, that's when precious metals historically perform best. So even the worst case scenario probably sets up an even better buying opportunity for those with dry powder and strong hands. The other risk is regulatory. Governments don't like it when citizens flee their currency for hard assets. They have a history of intervening in precious metals markets when things get out of hand. FDR confiscated gold. Nixon closed the gold window. The Hunt brothers got their silver position shut down. Could something similar happen again? It's possible, but it's also much harder to enforce in a globalized world with decentralized markets and digital platforms. Let's talk about what smart money is doing right now, because their actions speak louder than any analysis. Hedge funds have been building long positions in silver futures. The Commitment of Traders report, which shows positioning of different market participants, reveals that managed money is net long and adding to positions. These aren't retail speculators. These are sophisticated funds with research teams and risk management systems. Mining companies are another tell. Silver mining stocks have been outperforming the metal itself, which typically happens at the start of a bull market. When the stocks lead the metal, it suggests that informed investors are positioning for higher prices ahead. They're buying the leveraged play on silver through the miners, knowing that a move in the underlying metal translates to amplified moves in mining company profits and stock prices. And then there's the retail side. Coin dealers are reporting shortages. Premiums over spot price have been elevated for months. When you go to buy physical silver, you're paying significantly more than the paper price suggests you should. That spread tells you something important. There's a disconnect between the paper market and the physical market. And when those disconnects persist, eventually the paper price has to adjust to reality. Here's a question worth considering. What would it take for silver to not go significantly higher from here? You'd need industrial demand to collapse. You'd need new supply to come online rapidly. You'd need central banks to reverse course on monetary policy and start draining liquidity from the system. You'd need the geopolitical situation to stabilize. You'd need inflation expectations to fall. You'd need the dollar to strengthen significantly. How many of those things seem likely? Maybe one or two in isolation, but all of them together? The path of least resistance is clearly higher. The question isn't if silver moves, it's when and how far. Let me tell you about a conversation I had with a mining executive recently. He's been in the industry for 30 years, seen multiple boom and bust cycles, and he told me something that stuck with me. He said the current silver market reminds him of uranium before it went on its massive run, a commodity that was undervalued for years, supply constrained, demand growing from structural trends, and then suddenly the market woke up and prices went vertical. That's the setup we have in silver right now. A coiled spring that's been compressed for over a decade, and the catalysts to release that energy are lining up. Think about the average investor's portfolio. Stocks, bonds, maybe some real estate. How much exposure do they have to commodities, to hard assets, to things that benefit from inflation and monetary debasement? For most people, the answer is zero or close to it. They're entirely dependent on the financial system continuing to function smoothly, on central banks maintaining credibility, on governments managing their debt loads responsibly. What happens when those assumptions are tested? What happens when inflation proves more persistent than expected? What happens when the next crisis hits and the only tool in the toolbox is more money printing? The people who have positioned in hard assets, in real things with intrinsic value, they're the ones who preserve and grow their wealth. Silver sits at this unique intersection. It's a monetary metal with thousands of years of history as money, but it's also an industrial commodity that's essential for modern technology. That dual nature gives it characteristics of both a safe haven and a growth play. When investors are scared, they buy it for protection. When the economy is booming, industrial demand drives it higher. It wins in multiple scenarios. Now let's talk about timing, because that's what everyone wants to know. When does this move really accelerate? What's the catalyst that takes silver from interesting to unmissable? It could be a supply disruption, a major mine going offline, a country restricting exports, a shortage in the physical market that forces the paper market to adjust. It could be a monetary event, a currency crisis, a central bank losing control of inflation, a flight from sovereign debt. It could be a technical trigger, a breakout to new highs that brings in momentum traders and forces short covering. The truth is, we don't know exactly what the catalyst will be or when it will hit. But we know the conditions are in place. We know the fundamentals are aligned. We know the technical setup is bullish. And we know that when silver moves, it moves fast. By the time the catalyst is obvious to everyone, the easy money has already been made. This is where having a plan matters. If you wait for certainty, you wait for higher prices. The people who make life-changing returns in markets are the ones who position before the crowd. They do their research, they understand the setup, and they act while others are still debating. Speaking of positioning, if you're thinking about how to protect your retirement savings from everything we've been discussing, the market volatility, the monetary uncertainty, the geopolitical risks, there are strategies available that most people don't know about. I'm talking about ways to get exposure to physical precious metals inside your retirement accounts with the same tax advantages you have now. If you're sitting on $100,000 or more in retirement savings, this might be worth exploring. I put together information on how this works. It's in the description. No obligation, just education on your options. Something to consider as you think about protecting what you've worked your whole life to build. But let's get back to the bigger picture, because there's another angle to this story that doesn't get enough attention. The environmental and social governance movement, ESG, is creating additional demand for silver that most people aren't factoring in. Every solar panel requires silver. Every electric vehicle requires significantly more silver than a traditional car. The push toward green energy isn't just a policy preference. It's becoming mandated in many jurisdictions. And that mandate translates directly into silver demand that's not price sensitive. When a government requires a certain percentage of energy to come from renewables, when they mandate electric vehicle adoption, when they subsidize green technology, they're creating inelastic demand for the commodities those technologies require. Silver is at the top of that list. And unlike oil or copper, where high prices can incentivize new supply relatively quickly, silver supply can't respond fast enough to meet this surge in demand. Let me give you some numbers to put this in perspective. A single solar panel uses about 20 grams of silver. Doesn't sound like much. But when you're talking about gigawatts of solar capacity being installed globally every year, those grams add up to millions of ounces. Electric vehicles use about twice as much silver as traditional vehicles. Again, multiply that by millions of vehicles per year, and you're talking about massive incremental demand. And here's the thing about this demand. It's not going away. Even if silver prices double or triple, solar panels still get built. Electric vehicles still get manufactured. The economics of those industries don't hinge on silver prices because silver is a small component of the total cost. But the impact on the silver market is enormous because the volumes are so large. This is what's called inelastic demand. Price increases don't significantly reduce consumption. And when you have inelastic demand meeting constrained supply, you get explosive price moves. It's economics 101. But most investors aren't connecting these dots yet. There's also a generational shift happening in how people think about money and value. Younger investors who grew up during the financial crisis, who've seen currency debasement, who've watched their purchasing power erode, they're more open to alternative stores of value. They're buying silver, they're buying gold, they're diversifying away from pure fiat exposure in ways their parents never did. This isn't just about investment returns, it's about trust in the system. And that trust has been eroding for years. Every bailout, every round of quantitative easing, every time the rules get changed to benefit the connected at the expense of the average person, it chips away at confidence in the monetary system. And when confidence erodes, people look for alternatives. Silver is one of those alternatives. It's been money for 5,000 years. It's survived every empire, every currency, every financial system that's ever existed. When you hold physical silver, you're holding something that has intrinsic value, independent of any government or institution. That's powerful in an age where trust is in short supply. Now let's address something that comes up whenever silver gets discussed: the volatility. Silver is volatile, more volatile than gold, more volatile than most commodities. It can swing 10 or 15% in a week. That scares people. And it should, if you're not prepared for it. But here's the other side of that coin. Volatility creates opportunity. The same characteristic that makes silver scary on the downside makes it explosive on the upside. When silver runs, it doesn't go up 10 or 20%. It goes up 50, 100, 200%. The volatility is a feature, not a bug, if you understand how to position for it. The key is having the right time horizon and the right position size. If you're trying to trade silver on a day-to-day basis, the volatility will kill you. But if you're positioning for a multi-year bull market, if you're buying physical metal and holding it through the swings, then the volatility is just noise. You're not trying to catch every move. You're trying to capture the big trend. And the big trend is clearly up. Every major indicator points in the same direction. Supply deficit, industrial demand growth, monetary debasement, technical breakout, institutional accumulation, retail interest building. These aren't random factors. They're all pieces of the same puzzle. And when you step back and look at the complete picture, the conclusion is hard to avoid. Let me share one more historical parallel because it's instructive. In the 1970s, silver went from under $2 to over $50. That's a 25-fold increase. It happened because of inflation, monetary instability, and a supply squeeze. Sound familiar? The circumstances today are remarkably similar, but the scale is larger. The amount of currency in the system is larger. The supply deficit is larger. The industrial demand is larger. If we see even a fraction of the percentage move we saw in the 70s, we're talking about prices that would shock most people. And unlike the 70s, when silver was primarily a monetary metal, today it has this massive industrial demand component that provides a floor under prices. The downside is more limited. The upside is potentially unlimited. Here's what keeps me up at night, in a good way. We're at this unique moment in history where multiple mega trends are converging on a single commodity: the green energy transition, the breakdown of the post-World War II monetary order, the rise of emerging markets, the technological revolution requiring more silver than ever before, the loss of confidence in fiat currencies, the supply constraints from years of underinvestment in mining. Any one of these trends would be bullish for silver. But all of them happening simultaneously, that's the setup for a move that could define a generation of investors. The people who recognize this moment and position accordingly, they're the ones who will look back in 5 or 10 years and realize they were part of something historic. And here's the beautiful thing about silver compared to other investments. You don't need to be rich to participate. You don't need accredited investor status. You don't need a minimum investment of hundreds of thousands of dollars. You can start with whatever you can afford, a few ounces, a few $100s. And you can build a position over time. That accessibility is important because it means this opportunity is available to everyone. The truck driver, the teacher, the small business owner, anyone who's willing to do the research and take action can benefit from what's coming. This isn't some exclusive club. It's an open market where your analysis and timing matter more than your net worth. But, and this is crucial, you have to act while the opportunity is still available. Markets don't wait for you to be ready. They don't pause while you finish your research or save up more capital. They move when they move. And by the time everyone agrees that silver is going higher, by the time it's on the front page of every financial publication, the easy gains are gone. This is the time when conviction matters, when you have to trust your analysis even though the crowd isn't there yet, when you have to be comfortable being early, knowing that early often looks wrong until suddenly it looks genius. The investors who make the biggest returns are the ones who can handle that discomfort, who can buy when others are skeptical, who can hold when others are selling. I've been watching silver for years. I've seen false starts. I've seen breakouts that failed. I've seen all the reasons why it should go higher, only to watch it consolidate for another year. But this time feels different. The confluence of factors is unique. The technical setup is cleaner. The fundamental story is more compelling. The macro environment is more supportive. Could I be wrong? Of course. Markets are humbling. They have a way of making fools of even the most confident analysts. But the risk-reward here is so skewed to the upside that even if I'm only partially right, the returns could be substantial. And if I'm completely right, if this plays out the way the setup suggests it could, We're talking about one of the great trades of this decade. So what do you do with this information? That's up to you. Everyone's situation is different. Everyone's risk tolerance is different. Everyone's time horizon is different. But I'll tell you what I'm doing. I'm paying attention. I'm watching the supply data. I'm monitoring the technical levels. I'm tracking institutional flows. And I'm positioned for what I believe is coming. Because when I look at everything we've discussed, when I add up all the factors, when I consider the historical precedents and the current setup, I can't escape the conclusion that silver is gearing up for something big, maybe the biggest move we'll see in our investing lifetimes. And I don't want to be on the sidelines when it happens.